Welcome to the CLS Monthly Market Review. I'm Scott Kubian for Nick Rohrt. Joining me today is Chief Investment Officer Rusty Vanneman.
Hi,
Rusty,
Scott.
welcome.
Happy New Year.
Thank you. Same to you. So how did the markets end up in 2014?
Well, how'd they finish up? So, first of all, we did not get the Santa Claus rally to finish the month. So usually we have a nice end to the year. We did not. The last week of the year, we had losses. So the S&P finished unchanged on the month. But it was a great year for the stock market. The S&P was up 14%, and investors definitely benefited. It was a great year. The market is now up over 200% since the bull market started in March of 2009. And as you know, that's one of the longest and strongest bull markets we've ever had, at least in the last century. The bond market, great year as well, up 6% for the overall bond market, and long treasury bonds, the most hated asset class a year ago, was up over 20%. And as you know, being the risk expert, it has only a quarter of the volatility of the stock market. So on a risk-adjusted basis, bonds did great. Now, what didn't do so great was the international stock markets. The international stock markets lagged. They finished the year with losses. And obviously, they lagged the S&P. And here's a good number. You may not know this yet because all the numbers are still being crunched right now, but do you know what the average return was for a global manager last year? So if you look at the World Stock Morningstar peer group, what was the average return last year? I'll tell you because I've done the homework, so I know you do a lot of homework. The average return last year was only 2 to 3%, so the average global manager. Wow. So that obviously lagged quite a bit. Now, as for at CLS, how we did last year, I think we participated. Our investors benefited, but it was a mixed bag. On the domestic equities side, we had a very good year. We emphasized large companies. They did very well. We emphasized growth-oriented companies. They did very well. Our biggest sector tilt was technology. It did very well. So it was a very good year. It was on the international side. Again, we liked international. We were buying international, and we kept buying it through December. That didn't help. On the fixed income side, we made active decisions over the course of the year that also worked. We maintained interest rate sensitivity, and we decreased credit sensitivity. So altogether, we participated and had a decent year.
Great. There were a couple asset classes that moved pretty strong late in the year. Can you tell us about those?
Two big markets grabbed a lot of headlines and really big stories. So it was the dollar and energy stock prices. So the dollar ended the year at 11-year highs. And it's really interesting. 6 months ago, hated asset class, down on the year, and it had a great rally at the end of the year. And you know what? Hey, you were one of the people that were talking about it too, so you deserve credit for it. That's the reason why $1 is up, because you liked it. No, but it had a great year, and part of it was because people were expecting the U.S. to start raising rates before the other countries. Our view on the dollar moving forward is that we still give the benefit to more gains, but it's a good discussion right now because how much has it been priced already in? We've had a huge move, and we haven't actually seen the central banks do anything yet. And by some classic economic measures, the dollar is a little overvalued. Now, the other thing we want to talk about are energy stock prices. Completely different story. At mid-year, up double-digit returns, killing the S&P 500, having a great year, completely flipped around. Crude oil prices dropped 50% in the last 6 months of the year. It was a function of global demand slowing, but more about supply. The Middle East maintaining, and the U.S. production went gangbusters last year. So what do we think about energy right now? We like it because vastly oversold, undervalued, and we're already seeing a supply response a little bit. Energy stock prices the last couple weeks of the year did all right. So two big markets, and still deserve watching moving forward.
Great. Taking a step back to the sort of the big pictures, we got to year-end and tax planning and financial planning. What's the key job that an investment counselor provides? What's the key benefit they provide to their clients?
This is a big one too. As you well know, you've been managing money for decades too, that we just don't manage portfolios. We just don't manage numbers. We're also responsible for managing and helping manage investor emotions. And, the biggest reason why investors often don't reach their financial goals is because they're chasing performance. They're buying something after it's already gone up, or they're selling something after it's already gone down. So it's our job to make sure that greed and fear and complacency does not start to get into investor decision-making. And right now, we're looking at investor sentiment surveys. We're looking at current investor flows. And there's some pretty notable things happening right now. Investors are pretty bullish. They are pretty complacent. So, it's up to us. Investors might have a fire in their head, but it's really up to us to keep them balanced to make sure that that fire doesn't hurt their portfolio. People just maintain the balance, stay disciplined. They're going to reach their goals in the end. I think that's the job of us as counselors.
That's a great reminder, and really a great reminder for all of us. That'll do it for your monthly market review. Thank you for your time and trust in CLS Investments.